On Tuesday of this week, the Dow pushed through that 30K mark for the first time ever in history. It's become more and more apparent that the market does not care about the short-term pain. It is forward-looking. It's looking at earnings 2021, 2022, and we're all just hoping that that vaccine comes quicker and quicker and quicker. We all know that the stock market is not the economy. We've heard it hundreds and hundreds of times, but are we getting too greedy? Are we too forward-looking right now? And I thought this would be a perfect opportunity to share with you a tool that I use to determine what the underlying market sentiment is, the indicators that determine where we sit right now. Are we getting too greedy? My name's Nick. Welcome to Ways to Wealth. If this is your first time here, we highlight key events that happen in the market over the past week. And I'd like to ask you a huge favor. If you learn something new, if you get some value out of this video, smash the like button. It definitely helps my channel grow. And if you enjoy the video, if you like the content, please hit the subscribe button, turn that notification bell on. We do this every single week. We are talking about the Fear and Greed Index, and it reminds me of wise words from one of my heroes in the investing game, and that is Warren Buffett. And what he had to say was being fearful when others are greedy and greedy when others are fearful are some of the best tips when it comes to investing over the long term, to buy undervalued assets and sell when they start to get overvalued. And right now, with markets approaching all-time highs, even the Dow pushing through, making an all-time high this week, this is a good index to keep in your back pocket and something just to make sure that you know where the market's at today. The index has 7 different indicators. We'll go through each one, explain what they do, and we'll look at how they compare over time. The first indicator is a 5-day average of a put to call ratio. And if you're not familiar with puts and calls, puts are basically you think the stock is going to go down. Calls are that you think the stock is going to go up. So you're taking a look at over the past 5 days, are there more people placing bets on the market to go down? Or are there more people placing bets on the market to go up? From January to March, you had put options, which you think the market's going to go down, heavily outweighed call options. But as of late, you can see a more positive outlook. In the past 5 days, call options outweighed puts by over 70%. This is the most bullish sentiment we've seen in the past 12 months. The second indicator is referred to as a safe haven demand. And what it does is it measures a stock's performance and a bond's performance, the difference between the two over the past 20 days. Now, if you remember, a bond is used as a flight to safety. So when stocks are going down, people typically move towards bonds. They shift over a large percentage of that portfolio. I did talk on this on a previous video. I'll throw a link to that above. It's the 60-40 balanced portfolio, 60% in equities, 40% in bonds. So you can learn a little bit more about that composition. But when people are favoring bonds, it means that the underlying stock market is weak, the sentiment is low. But over the past 20 days, we've actually seen the stock performance outweigh the bond performance by over 11%. Now, when you look at the past 2 years of data, this is some of the strongest market sentiment we have seen. And it looks like people are rotating from bonds back into equities. The third indicator of the Fear and Greed Index is simply referred to as stock price strength. And as the name indicates, it looks through the New York Stock Exchange and it sees how many companies are hitting all-time highs. Are they hitting higher highs? Or are more companies hitting all-time lows, lower lows? And the sentiment is easy here. If there's more companies hitting all-time highs, this ratio is beneficial towards a bullish market. People are happy with where the stock market and economy is going. And if more companies are hitting lows, then that means that the underlying tone is very bearish and very scary. Next up at number 4 is the McClellan market breadth. Now, what this is in very simplistic terms on the market breadth side of things is how many companies are participating in a run. No matter whether it's bearish or bullish, it's just how much of the stock market is participating. Earlier this year, from March to September, it seemed to be the tech stocks or the stay-at-home stocks that had kind of brought the market back up. But since September or October, we've started to see the value names come in, the financials and so forth. So now we have more of a well-rounded market. It's not just a few sectors that are kind of leading the race. Currently, this ratio is hitting some of its all-time highs that we've seen over the past couple of years on the upper range of having more of the market participating. Number 5 is market momentum. It takes a look at the S&P 500 index. So the top 500 companies in the US, and it compares it to its 125-day moving average. The further north the index is above that 125-day average, the more bullish it is, the more people are anticipating great results in the economy. When it's below, it's bearish. It is not a good sign. On November 20th, the rating change by the Fear and Greed Index was changed from greed to extreme greed. The 6th indicator on the list is junk bond demand versus investment grade bonds. The lower the spread between the two, the more the greed. So basically what this means is investment grade bonds are relatively safe. These are where people are flocking when the stock market isn't doing so well, whereas junk bonds are kind of relatively similar to stocks. So if a junk bond company is probably not rated on a credit scale, meaning that they're probably not likely to pay back the bond amount in a recession, it means that if people are flocking towards junk bonds, it means that they must believe that the underlying economy is good. And although that spread is relatively higher than what it was in January, it's definitely lower than what it was in March. And people are moving towards higher risk strategies. Last but not least, the final indicator is market volatility. And what this is it measures the VIX in comparison to its 50-day moving average. And if you're not familiar with what the VIX is, it is a market volatility tool, and it gives you an indication of how volatile the market is going to be over the next 30 days. To make it very simple, the higher this number is, the more volatile the market, and typically bearish. The lower the number is, it is a pretty good sign, and it means that the market is not going to be so volatile. The VIX takes into account options, how many options are being played on the market. It doesn't segregate between puts and calls, but typically when there are more options in the market, it does indicate a higher VIX. So to truly simplify it, be very fearful when the VIX is high and be very greedy when the VIX is low. We did close out this week at around 20, which is still relatively high in comparison to history over the past. This typically trends at 10, 12, around there, but it's definitely a far cry from the high of 82 that we saw earlier this year. So those are the 7 indicators that go into making the Fear and Greed Index. And it's what we use to see what the underlying market sentiment is. And as you can see today, this number is extremely greedy right now. It's 92 out of 100. Only 1 week ago, it was 63 out of 100, just in that greed category. But you can see that the vaccine news, there's a little bit of political news that is driving the markets higher. Now, it's up to you to take a look at what this chart has done in the past in correlation to the markets. And it shows you on the page, which I will link down below, to tell you when the market is extremely greedy, when it's extremely fearful. But I am not a financial advisor, so get to know it, do a little bit more research on it, and see how it could potentially help you in your portfolio. And that's all for this week in the market recap. I hope you enjoyed the video. Again, I'd like to ask you a huge favor. If you got some value out of the video, smash the like button. It definitely helps my channel out. And if you're here and you're enjoying the content, do me a favor, hit that subscribe button, turn that notification bell on. We do this every single week. I hope you all have a great week in the markets. Happy trading.